everyone doing tonight? Great. Okay, so my job today, what I do for Wall Street, what I do for economists, what I do for real estate firms across the country is try to explain housing data in a fashion you can understand, but how you can explain to your clients. Because for the last 11 years, all I've heard is housing's 2008. Every year, we're on the verge of a super collapse again, over and over and over. And why did it happen? The data I'm going to show you today actually will explain everything. And I'm going to first start off with one of the most crucial data lines we have in this country that never gets talked about. It's going to be the NAR's total inventory data. And it's going to go back to 1982. No, previous one. Oh, there it is. So the NAR comes out with its monthly active listings. Historically, if you look at that chart going back to 1982, 2 to 2.5 million. If you go back to the early 1980s, what do you see? We had a lot more inventory back then. When you go back to the year 2000, where that first black line is drawn all the way up, we had 2 million active listings going all the way up to 2.5 million active listings in 2005. And then we had the big housing collapse, right? Credit channels run inventory channels. So what occurred is, after the housing bust, we had the first time in the last 4 decades, we had an inventory spike from 2.5 million to 4 million. In 2007, inventory peaked 1 year before the Great Recession. Not a lot of people know that because nobody shows the chart this way. And then from 2007, the long draw down to where we are today. Does anybody know how many active listings we have in America today?
570,000.
Close. It's a little bit above 1 million right now. Except there's one other thing. We have a lot more people now in this country than we did in the 1980s. So when you take total active listings, compare it to the population of the country, compare it to the households, it's the lowest levels ever recorded in US history. So if you have clients that are talking about, oh, housing's in a bubble, everything's going to crash, all day. Just show this chart all day. And then you compare it to what we had in 2007. 4 million versus 1 million, right? A lot more people working. We have over 155 million people working right now. Households are the highest ever. That chart will show all your clients, we're not 2008, we're not 2007, not 2006, 2005, 1984, 1991, none of those periods and times, except now it's the lowest levels of active listings in US history. But the second chart is going to be even more crazy. Here at Housing Wire, what we do is we track weekly inventory data, single family weekly listings. Can anybody guess how low single family active listings got last year?
30,000.
No. Anybody else?
250,000.
Close it up. 240,000 active listings in a country of 330 million. That's where we're at last year. I coined the phrase savagely unhealthy housing market last year. Why? Because unlike the housing bubble, where we had a massive credit boom, here we simply had too many people chasing too few homes. And because of that, prices escalated out of control. You're all in New Jersey. You've seen what goes on here, right? We got to such low levels that multiple bids became 75% of the marketplace in 2022 when we got inventory that low. Very difficult problem to solve unless rates got high enough to try to cool down the market. And last year, we had the biggest mortgage rate spike in history. That's all the inventory that was created last year. So when people talk about inventory spiking, Guess where we're at right now? Anyone?
270.
420,000 single-family homes across the country today. Again, for a country of 330 million, that's all. We have the weekly active listings data. We update it every Sunday with our Housing Wire tracker. And so far this year, one of the craziest stats that I've seen is last year between May 13th to May 20th, we had 25,000 increase of active listings last year. So far this year, from the seasonal bottom, we haven't even had 19,000. So when inventory isn't growing, right in the spring selling season, guess what happens? Multiple bids. But the next chart is even going to be worse. New listings data. Something that doesn't get talked about a lot. Only a few firms have it. New listings data was trending at all-time lows in 2021. And then they were trending at all-time lows in 2022. We had a few weeks where we saw year-over-year growth, but if you notice that black line on the bottom, new listings data after the biggest home sales collapse year in history trended at all-time lows. After the second half of 2022, people just said, hey, I'm not buying a home. Mortgage rates are 7%, forget it, I'm done. And it feeded itself all the way down to 2023. Year-over-year percentage declines in new listings is about 20%. Again, when they talk about 2008, that doesn't look like 2008, right? That looks like inventory is not only at all-time lows, but new listings is trending at all-time lows. You cannot have a supply spike in this country without new listings data exploding at least to 2018 or 2017 levels. So this entire talking point last year that home prices are crashing, the housing bubble's over with. Mortgage rates went from 7.375 to 5.99%, changed the entire market starting November 9th. That's what we do with tracker data. We are here to track forward-looking data because since the 1990s, when we've had access to this, it always worked. And what happens, the media starts to play, hey, what gets all the clicks? What gets all the attention? Your home prices are going to go down 20, 30%. You just saw those three charts. Does anything look like a supply spike like we saw in 2007? No, none of it does. So new listings data, until it gets back to normal, we are stuck here in a very, very low inventory environment. And all of you know in New Jersey, it's even worse. There's your state right there. Pretty much at all-time lows. Imagine if mortgage rates went down to 5%, how bad it can get here in New Jersey. Because a lot of people thought, hey, nobody's going to buy homes at 6% or 7%. You had 1% decrease. It created all-time lows in inventory. It's not going to work, right? And this is a problem because one thing that we all forget when we talk about housing economics, a traditional seller is a traditional buyer, 75 to 82% of the time. So if people aren't listing their homes, that demand goes away. That supply goes away. That buyer goes away too. So now you're dealing with the lowest inventories ever recorded in history for your state. What happens if mortgage rates go down? Now, a lot of people will tell you, we're in a mortgage rate lockdown. And then if mortgage rates come down, people will come list their homes and they'll flood the market. It's never happened once. When mortgage rates fall, demand gets better. Traditionally, inventory falls in that environment. So this is the fear of this time and period in U.S. economics. We're already starting from a very low level with higher rates. Rates aren't going to go too much higher, but they can go lower. So when you talk to your clients, you have now 4 data lines going back to 1982 to show you that active listings are near all-time lows, New listings data is trending at all-time lows, and the state of New Jersey is at all-time lows in inventory. None of this was happening in 2008. So how do you explain housing economics in a simple way? This is purchase application data, mortgage demand. Notice the first black line. That was a massive credit boom back in 2002 to 2005. Does it look like we had anything like that in the last 10 years? Nothing, right? Millions and millions of people buy homes every single year. But what occurred is we have traditional buyers with 30-year fixed mortgages. Have you heard of the concept, what is the best hedge against inflation on planet Earth? It's real estate. Why is that? If you have a 30-year fixed mortgage in America, you're golden. You have a fixed debt payment, your wages have been rising for years, and all of a sudden we have this massive inflation. Why does that matter? Traditionally, your wages go up during inflation period. But if you have a 30-year fixed mortgage, that debt cost stays the same. Do you know how many countries around the world hate us for this? They have ARM loans, 2, 3, 5-year recast. We're the only ones that have a major traditional 30-year fixed mortgage for the entire country. So then people said, well, all these people are going to go sell because they have home equity gains. And do what? A traditional seller is a traditional buyer. So the missing concept here is that Americans have been living in their homes longer and longer. From 1985 to 2007, housing tenure was 5 to 7 years. From 2008 to 2023, you want to guess where it is now?
12 years.
Good. And, traditionally right now we're looking at 11 to 13 years, except some states, 15 to 18 years. I've lived in my home for 19 years. We have been building bigger and bigger homes for the decades now. Our family sizes have gotten smaller and smaller. 1975, median square foot being built, 1,500. You know what the recent high was? In 2014, it got to 2,700. So the product that we've been building for decades, a lot of one and done. Now, if you live in an older home that's very small, you naturally need to move. But if you have a traditional starter home now, that traditional starter home could fit a family of 4, even 5. So when COVID happened, a lot of people said we need bigger space. So it got some people moving. But outside of that, people just aren't moving as much. And the baby boomers are staying in their homes for a very long time. Has anybody heard the concept, the silver tsunami? It's a mythical story that by 2015, every baby boomer was going to sell their homes to millennials who couldn't buy, and we would have 26 to 30 million active listings put on the market for 10 years, from 2015 to 2025. Why 2015? Because the first baby boomer hit 62 in 2008. And by that time, they're all going to downsize. We have 1 million active listings today. We got down to 240,000 single family. Didn't happen, right? Another scare tactic. So here, I think the best lesson for this is that we never had a credit or sales boom, so you cannot have a credit or sales bust. Bust meaning that supply just escalates out of control. Those red lines drawn, this is existing home sales. When mortgage rates rise, demand falls. We saw this in 2013 and 14. We saw this in 2018 and 19. I think 2018 was the ground zero of housing bubble 2.0 crash. We went from 5.72 million monthly sales to 4.98. Do you want to know how much inventory grew that year? 0. So when the time comes that you're going to see a bigger sales class, everybody's going to say inventory is going to skyrocket, right? It did it. 2022 was the biggest home sale crash year ever in history. It was a waterfall dive in demand. Mortgage rates went up so much, so fast. You had sellers basically calling it quits. And again, it didn't create much inventory. So when people say when housing collapse, you'll see massive home price declines. Next chart. If you can't see it, if you need to come closer, that's the housing bubble crash right there. That little tiny decline. There it is. Okay? All this talking for 11 years. A lot of guys got older too during that 11-year period of time. And that was the moment in history that when home sales collapsed, we'd have one of the biggest price decline years ever. By the way, 2022 home prices were up. They didn't decline. In the second half of the year, we saw month-to-month declines, but the year also started off at like 17, 18%. That's why we had total home price growth. So what's occurred now is that on October 27th, what I wrote for Housing Wire is the case for lower mortgage rates. During that period of time, the next 2 to 3 months, mortgage rates fell, demand stabilized. So you see that big waterfall dive in demand we saw last year. Done. You can't get that collapse anymore. If demand stabilizes, how is pricing going to fall down so much with total inventory where it is? That defies everything we've learned about supply and demand economics. So now prices is firming up because the sales data has stopped collapsing. The media is 3 months behind, but here at Housing Wire, we believe tracking forward-looking data works. And we were talking about this in November and December, and I'm thinking, this is the 4th time in the last 10 years. You've seen it. You can explain this to your clients. Math, facts, and data works. The rest is storytelling. I get it. It's a business model. You got to get people's attention. This, though, this is my money chart. Every single conference I've gone to for the last few years, every Wall Street firm, every housing conference, I go, this absolutely destroys the 2008 case. This is foreclosures and bankruptcies. Did you see how much drama we had at the early part of the century? A lot of bankruptcies being filed before the job loss recession. Well, guess what happened? 2005 bankruptcy reform law changed everything. Everybody rushed to file for bankruptcy the last year. That's why you see that big spike. And then we saw credit deteriorate. 2005, 2006, 2007, 2008. Then the job loss recession happened. None of that was happening in the last 12 years. So when people say it's 2008 over again, all you need to do is show this. Because if it's 2008, you need at least 4 years of credit stress built up, then the job loss recession. So you're like 2001 now. You're like 6, 7 years behind. So you cannot have what I call forced credit sellers. Nobody sells their homes to be homeless, right? Doesn't make sense. But when you're in a foreclosure, you lose the ability to buy a home. See that tiny, tiny little black line? It's hard to see. I totally understand. That's the foreclosure data. Do you see how it was from 2005, 6, 7, and 8? This was all happening before the job loss recession. 4 years of credit stress with the unemployment rate falling down. Then the job loss recession happened. So if anybody ever says to you, 2008 all over again, you just show them your chart and say, not gonna happen. They're like 20 years behind the curve. Reading is a good thing. That's what I would say. Right? The history of human civilization said that. People that don't read or look at charts, they're stuck in 2008. Mortgage origination, FICO scores. This is one of my pretty charts, I say. After the 2010 QM laws were put into place, we facilitated the best home loan profile ever in history. And our family's been in banking since the late 1950s. Nothing is ever going to look this good. Why? Because people that buy homes now, fixed debt costs, origination, FICO scores are good to start off with. Guess what happened? Their data got, their FICO score got better, their cash flow got better. Why? Because their wages rise every year. Their total housing
cost goes less every day. Then we had 3 refinancing waves, 2012, 2016, and the mega refinancing wave, 2020 to 2021. So think about all these homeowners whose wages have grown for over 10 years. They're sitting in their homes for over 10 years. Now their housing cost is so low to their wages. That's hedging against inflation. Mm-hmm. You think people are going to give that up? 2008 over again? So homeowners on paper look great, right? Those 2 charts right there will show if any of your clients go. But I heard Uncle Dave on Facebook said housing was going to crash like it did for every year since 2008. It's not going to work anymore, right? You have the data to explain this in the simplest fashions ever. Try to convince your homeowners, home sellers, home buyers, housing is a cost of shelter, right? It's just the payment that you're buying to live in. Millions of people are buying homes every single year. We had 5.5 million total home sales last year, right? Even this year, we got over 4.5 million. Those people are going to buy. They're good. They're protected. Fixed costs, rising wages. This is the not fair chart. Does anybody here know how many homes in America do not have a mortgage? The percentage. Yes. 42% of homes in America don't even have a mortgage. I kind of joke with Sarah. How's that a mortgage rate lockdown, Sarah? If 42% of homes don't have a mortgage.
Oh, I'm with you on this side. I'm with you on this time.
So, on top of all the nested equity they have and the fixed payments, a lot of homeowners don't even have a mortgage to worry about. How are you going to foreclose on a house that doesn't have a mortgage? Funny concept. You hear people say foreclosure crisis, foreclosure crisis. So when the foreclosure data happens, remember this, that we have the best nested equity positions in the history of the world. Our nested equity, just in our home values, is bigger than the total GDP of China. Like maybe Cleopatra in her peak had more wealth than the United States of America. This is it. And he noticed that the mortgage debt never really expanded higher than housing mortgage. We just basically have come back there because we never had a massive credit boom. That's why that blue line doesn't look too much higher than the peak that we saw in 2008. So eventually, at some point, we will have a job loss recession. I have a foreclosure model, and like most of you see, this is in 2005, it's in 2006, 7, or 8. What you're going to have is eventually when somebody loses their job, right now, 30, 60, 90, 120 days late are near all-time lows. Does anybody remember the forbearance crash bros? Right? There were a bunch of people that said forbearance was going to destroy the U.S. housing market. In September of 2020, I coined them that, the forbearance crash bros. It's a bunch of guys on YouTube who have never read textbooks in their lives saying everything's going to collapse. Guess what happened? Forbearance collapsed. Does anybody know the forbearance percentage delinquencies now? 0.51%. Crash bros, that's a good word. So when this occurs, right, when we do have a job loss recession, it's what we call late cycle lending risk. You have to follow a 30-day. Then it becomes a 60-day. Then it becomes a 90-day. Then it becomes a notice of default. You're looking at a minimum 9 to 12 months before that inventory could possibly hit the marketplace. So when they go, supply is going to spike up, it's not going to be from foreclosures. That's a 2025 or 2026 story. And look where we're standing. Near all-time lows. 240,000 single-family homes in America last year. That's where we're working off of. So you have seen the foreclosure data. You see the bankruptcy data. You see the FICO scores. You see the nested equity. Does it seem like we're going to have a foreclosure crisis anytime soon? No. And I am assuming the fastest timeline because most likely it's going to take about 16 to 24 months to get any kind of new foreclosure supply into the marketplace. Some cases you could say that's Now, a positive story for inventory. You are right. That's not going to come to anybody's rescue. Now,
Sorry.
I am a technical gatekeeper when it comes to mortgage rates. I only forecast the bond market to where I think mortgage rates can go. We've had a lot of drama this year, but before the year started, I thought the 10-year yield and mortgage rates, they do this slow dance since 1971. We'll have to start with that next. But 5.75 to 7.25%, that's where I thought mortgage rates will be. The only way the bond market and mortgage rates can fall down below 5.75 is if the labor market gets weaker. Now, today, mortgage rates are at 7%. Guess what happened a few weeks ago? Banking crisis stressed the market out. Mortgage spreads, the difference between the 10-year yield and 30-year mortgage is getting worse and worse. That's the banking crisis because the Federal Reserve has just become lazy. Not trying to talk the market up or help the mortgage market. So we're dealing still with the range that I thought. And even with mortgage rates basically being between 6 to 7% this year, you can see the inventory spiking. Why? Because homeowners are in such good shape. Now you have all the data, you have all the information now. No more excuses. Right? You can show that to your clients. So where mortgage rates are right now, for me personally, it looks good. It looks where it should be. If the labor market does get weaker, mortgage rates will go down. Imagine the U.S. housing market with 5% mortgage rates. We lived through that drama again. And because too many people are chasing cheap units, home sales are already really low, that could be a problem. And now you have the data to show people exactly where everything is. So I joke, and I say that the 10-year yield and mortgage rates have had a lovely romantic slowdown since 1971. So you can see here, they don't really drift apart from each other. A lot of people talked about inflation being as bad as it was in the late 70s, and that mortgage rates could go to 10 to 15%, like it did in the 1970s. If that was the case, the bond market would be exploding higher right now, and mortgage rates would be well over 10%. Even with the most unhealthiest mortgage market we have seen in over 3 decades, mortgage rates are 7%. They should be 5.5% today in a normal marketplace. Eventually, in time, the mortgage spreads will get better. Right now, they're dancing a little bit too far apart from each other. But when they come back, you have to realize the bond market and mortgage rates have the best relationship out there. So if you want to know how mortgage rates work, the 10-year yield, mortgage rates, we do this at Housing Wire every week. We try to explain the economics of how mortgage rates work. A lot of people push inflation, but there's a lot of economic data that matters. We break every single economic report down. And the big move has already been done. The Federal Reserve is giving up on the housing market for now, but eventually they will come back. And when that happens, mortgage rates are going up or down, slightly down from where we are. Because this relationship has been very helpful. It's a very good slogan. Right now, I have used cultural references. When the year started, I said, I'm bringing Gandalf out. Lord of the Rings. You shall not pass. You see that red line? I said it's going to be really hard for the 10-year yield to break under 3.37%. Now, I did not think we would have 8 tests before July the 4th, but it's here. So if you're trying to explain to your clients, mortgage rates, 10-year yield, we do that at Housing Wire. Our podcasts, Sarah and I talk twice a week. We try to give people channels to work with so you can have an idea. And we have stayed the course that when the 10-year yield mortgage rates get to this level, it's going to be really hard to break. I know everybody wants lower mortgage rates, but I thought, okay, this is going to be, the economic data is just too firm right now for bond yields to break. And that red line has shown it there. So I think this is the big battle between, other housing economics. When will mortgage rates break under 6% noticeably? I don't see that yet until the job data gets weaker. That means jobless claims have to rise much higher than they are right now. When that happens, there's a better case for lower mortgage rates. I know a lot of people thought May 10th was going to be the day or anything in that fashion. Just remember economics and the cycles kind of work together. So the labor market needs to break for that. Doesn't need to mean millions of people need to lose their jobs. It just means the Federal Reserve just wants more labor supply. They're petrified in the 1970s, but if it was the 1970s, mortgage rates would be much higher today. So what have we learned? Number one, it's not 2008, it's not 2007, it's not 2005, it's not 2000, it's not 1995. It's a fun year, by the way. It's not the early 80s, not even late 70s. All those references have nothing to do with the housing market today, last year, or the last 7 or 8 years. But you have to have the data to show people, because if your clients are going on YouTube, you're in trouble. If your clients are listening to their Uncle Frank, it's always Uncle Frank. They're going to be in trouble. If they're going to talk about home prices have gone up so much, they have to go back down here. Okay, supply, demand, economics. Demand is stabilized, inventory is low. There is nothing in history that we have that says prices crash in a stable demand, low inventory environment. Credit looks great, equity looks great, delinquencies look great, foreclosure data don't exist. It's a little black line too, so you might have to get your glasses out to see that. All this for that little decline in home prices. Imagine your life telling everybody housing is going to crash for 11 years, and that was your crash, and you got 11 years old. That's what a lot of guys have done. But now you have the data, and hopefully you could explain the data to clients that do not have access to this. So in that regard, just show them the charts. Over the last 10 years, showing people the charts actually, whoa, I did not know inventory was that low. I did not know the FICO scores were that great. I did not know the foreclosure data was that wonderful looking. They don't have that information. So it's your job to give it to them. And then they can think about it like every homebuyer does every year. Housing is the cost of shelter. That's what people are buying, the payment. Make them feel good about the payment. Make them feel good about the situation. And then they won't listen to Uncle Frank. They won't go to YouTube. They won't listen to the media. Force them to read the numbers. Force them to read the charts. And then you'll have an easier relationship with your client.
I listen to this weekly, so I know the references. He and I do have a slow song. It's Bryan Adams, Everything I Do It For You. It's my favorite 90s slow dance song, so you guys need to come up with your own. But I want to open this time for Q&A. Please, by all means, have something ready to ask, because it's your one and only time. I'm just going to ask you to project, because I want to do this.
Hi, my name is Diana. When you're doing the act, how does it come to property? How many people play with that? Is that counted when it's shown, or when it becomes
So
on the MLS? So what happens with the off-market inventory that some agents are taking exclusive?
So we have access to new listings data, whether it's off market or on market, it pops up there. Now with Altos Research, we have new listings data and we have new listings data that are being sold, that goes into contract. We also have that for every zip code in America. So the data that most of you guys have been following is 3 months old. We are weekly And because we are weekly, we get to see how many new listings are coming up, but how many new listings go into contract. It doesn't take long in some markets, right? New Jersey. So when that occurs, it'll fall into the sales data, the pending sales data, and that keeps the active listings low. So people go, how do you have big home sales this year with active listings? Well, if you list a home and they sell it, by the way, it's not going to fall in the 30 to 45 day the NA market. So this is why the weekly data gives us an advantage to see how the markets are reacting. Now, I have a whole different economic model too, with purchase application data. When that gets better, 30 to 90 days, sales get better. But having the new listings and the pending sales gives us an edge in every single zip code in America. And you can actually see, is it a buyer's market? Is it a seller's market? There are some areas that inventory is low, but still the affordability is such an issue in certain parts of California where I live that it didn't matter that active listings were that low. It's just the affordability. But the new listings data and the pending sales filter into the MNR data, which is old.
Like,
So, anytime soon, and I agree with you, obviously. My question is, where do you see opportunities for India? Because that's the biggest challenge on the brokerage side.
So unfortunately, this is a difficult conversation because for the last 7 to 8 years, what do we see? Inventory is slowly falling, right? My economic work in the previous decade, I said, 2008 to 2019 would have the weakest housing recovery. What I mean by recovery is not crisis, it's new home sales, mortgage demand, housing construction. But years 2020 to 2024 has the biggest housing demographic patch ever reported in history. That means ages 28 to 35. So I have this skit that I used to do back in the last decade. I still do it sometimes. We're not difficult people to understand. We rent, we date, we mate, we get married. 3.5 years after marriage, we have kids. We typically buy homes or something bigger in that environment. We don't live in apartments in that sense. So years 20 to 24 has the biggest, youngest demographic patch ever. And that's when birth rates should rise. 2020, pregnancy deaths have off. Birth rates are rising from a low level. Everything makes sense because, we get married in the late 20s now, we have kids in the 30s. It's very hard to get active inventory to grow unless you have weakness in demand and days on market grow and inventory can accumulate. This has been my talking point for 7 or 8 years now. 2014 was the last year we had inventory growth as a country. Demand was weak that year, days on market were growing. That was days on market was like 60, 70 days back then. Now, we're dealing with teenager days. And I always say this, nothing good happens in America when housing days on market are teenager less. That means you have a credit boom or you have too many people chasing too few homes. We have the second one. So it's difficult. The only model I have is that demand gets weaker, days on market grow, you get inventory accumulation, or the baby boomers start dying, which is something that will happen, in 10 years from now. They'll give their homes to their kids. So mortgage rates going up actually has created inventory because it creates weakness in demand and days on market to grow. It's just not the inventory growth that people have thought about. I think a lot of people, at least in the economic world, are running models that are based on credit channels that were prominent from the years 2010 and past. Now everybody has a 30-year fixed mortgage. There's no short-term rates anymore. Your total housing payments versus your wages in America are the lowest ever in history. Right? I can bring like 10,000 charts to show this, but trust me on this. Homeowners have it really good. So you have to have a valid reason. Good example is a friend of mine had $1,600 mortgage, total mortgage payment. To buy a home in California, it's going to go up to $5,700. It's a big jump, right? So if you have the income, not a problem. If you don't have the income, you're not moving. So that's That's the frustrating part about inventory. So I think it's going to be, as I call it, needing patience for inventory to grow because we're working from such low levels. We should try to get ourselves back to 2019 levels where we have a functioning market rate, days on market, 30, 40 days. That'll be a better environment for everyone. But 1% down in mortgage rates, and we're almost back down to teenager levels again.
Anybody else?
So based on the drastic change of inventory.
You mean inventory going up and prices coming down?
Yeah, yes.
So
And also how the elections for next year would influence.
So I'm not a big political economic theory person, but I do have a model on what will it take to get an inventory spike. You need mortgage rates to stay above 7% for at least 2 to 3 years. That will be difficult. You need a job loss recession where you have more functioning foreclosure channels. And during that 2 to 3 year period, if rates stay, the reason I say this is that this happened in the 1970s actually. Mortgage rates and the 10-year yield actually rose during both recessions in the mid-70s and also in the early 80s. That can create inventory like we saw in the early 1980s. There was a lot of, we had 2 million more active listings in the 1980s, early 1980s. We had a lot less people back then. So in that environment, inventory can grow from forced sellers, from weakness in demand, but outside of that, if mortgage rates come back down, see, one of the reasons I don't like the mortgage rate lockdown is because I can already see what the crash people are saying. They're going to say, well, when mortgage rates come lower, guess what? Everyone's going to flood the market, and then nobody could afford a home. Sellers and buyer, they list their homes. They already know they can qualify for a house. 75, 82% of them. So mortgage rates go down. Inventory does not increase in that situation, right? That's the difficulty part. We just have to find a way to get back to pre-COVID levels so we can have more days on market. But to answer your question, higher mortgage rates, job loss recession, rates don't come down. The Federal Reserve trashes housing even more. Something to that nature is actually workable with the data that we've seen after 2010. And I think the entire housing economic landscape changed after 2010 with the qualified mortgage rules. It's just that a lot of analysts are too young or didn't understand the credit channels from 1980 to 2010, and they're thinking that inventory rises with higher demand. That did happen from the year 2000 to 2005. Not anymore. Go take it.
So I've had a different experience than what I'm hearing from a lot of people, and I haven't had the opportunity to check this once. But there's a generational change in the preference of purchase and rent that I think that the reality is that the profit margin of developers building 300 and 400 unit buildings, etc., is because there is a clear shift in the preference, the responsibility of homeownership to rent, and it's not about whether they can afford to not because they pay more. In these buildings where they're paying the rent, they're paying substantially more than what some will be paying for mortgage, and as a result of that, the developers, those of us who may double it down, profit substantially from a simple preference shift that's happening in the generation. I just don't feel like we're having a conversation. And so while there is what appears to be a decrease in inventory, I'm not sure that I 100% agree with its lack of proportion to demand, because there's also a decrease in the preference of making the purchase. And so there's certain price ranges where the struggle gets a little bit more intense. And so in that, there's almost a real estate professionals would love to say that all the houses that we sell are really trucks. The reality is many of us can attest to the fact that we made a career out of people who purchased between that $300,000 and $600,000 bracket.
which has been probably 80-90% of my career in almost a decade. I've sold much more, and then we've sold much less. But is that the economics of our sales have been right within that, and there is always competition. There always will be, but then that low to middle class income bracket is always in every market. It's always in competitiveness in the real estate market, and that, in my opinion, has not changed. What the interest rate did, obviously, is so that the monthly payments, not the purchase price necessarily, because we've seen some weird change in the purchase prices, but whether the purchase prices go up or down, that just kind of happens in society. Gas prices will never be 99 cents. Times change. This is what it is. But with the purchase price, so the minimum wage change, etc. So we have things in place governmentally that kind of substantiate for that. But the interest rate change made it so that the multifamily market for the regular home buyer that used to only want a single family home increased. And that really calls from people who may have only wanted a single family home that are now kind of open-minded to having that because it comes with the monthly payment, et cetera, et cetera. And so I don't want to say that I'm not seeing an inventory decline. I simply think that I'm seeing the inventory decline proportionally to what's happening in society overall. Now, I don't feel like it's as imbalanced as what we complain about. I think there's education. And I think that if we start to deal with our clients in a way that we educate them on what purchasing is like in this current market, then this is like, as of right now, I have a 70, 80% rate, and this is, I don't want to make the numbers here, so that hasn't related to this, but I got like a 70, 80% rate of me going out for one-day with buyers and coming back home to making a couple of offers. And of those couple of offers that I make, I'm looking at maybe another 70, 80% rate of actually having the offers accepted, not because I think I'm better than anybody, but because we have to educate the buyers on the fact that this might not be this might not be the market's a low ball. This might not be, but you might have to pay what this is worth. There's a possibility that you might not be able to get that, $2 right this very second. I think if we as agents make sure that we talk to our clients, and we're only talking about buyers, to make sure that they're understanding that the market doesn't allow for that you heard your uncle talk about from the agents, then I think that we might get a better predicament. Realistic decision, but the fact is, you don't have to drive the 500 gas station hoping to find one for 9 cents. It's not there. You need gas. and at the end of the day, whenever we go and have that conversation, well, maybe outside of the lease for another year, I'm like, wait a second. But, you're giving the landlord, and I am the landlord, you're giving the landlord this extra money for another period of time, so to let them know the ignorance of the fact that maybe I should buy right now. I think it's really just an education. I think that what we have to go to is as opposed to complaining about the conditions as we are, to realize that as much as we love, Miami Beach vacations, etc., we as agents and real estate professionals still have a responsibility of staying eligible for what's happening in the market, and we have a responsibility to educate our clients like this. I think that sellers are, kind of in a place where right now, I'm dealing with sellers who are developing. Expectations of anything, but also a little bit. I literally sold a 2-family new construction for $750,000 on streets. And and I was surprised by it, but my offer was $770 million. The seller was just convinced me that this was just the way to go. And so while we let one put it on the buyer, we have a seller that the appraiser has a completely different and but the seller gave it up on the other hand because the buyer still paid the maximum amount that was possible for the seller because of the appraisal. I think I might go all over the place now because I think that my experience or my observation is just a little bit different. And while I'm looking at the same data with the inventory, I just feel like it's really proportionate to where we are society as real estate professionals, and I think that it kind of take on the burden of just educating what it means to purchase in this market. And the last thing I would say, I think that the interest rate has a tremendous impact on 3-family and 4-family home purchases and sales tremendously.
just because FHA has always required a self-sufficiency. And the raise of the interest rate, which means the monthly payments, are made it so that the properties are not self-sufficient according to FHA. So now all of our FHA buyers who are willing to do multifamily now, they would love to, but can't get them. Not because they personally can't afford multifamily, but because self-sufficiency boom was allowed. That is probably one of the things that in this group session I've still heard anybody talk about. I don't know what the solution is for that. The rest of it seems to be education and just good communication. But that is a legitimate issue that the interest rate creates.
Well, like the one chart showed, whenever mortgage rates rise, demand falls. Does anybody know the home ownership vacancy rate in America?
Homeownership
Vacancy rate. It's 0.8%. Vacancy rates are rising for rental units just because we've been building more multifamily construction in the last 2 years than we had in the last 30 years. We have 900,000 apartments under construction right now. It takes like every month it's like maybe 28,000 come online. Where rent growth is actually slowing down, home ownership vacancy is not moving much. What all of you have to deal with is what I call stingy sellers. The home builders, on the other hand, why are new home sales doing well? Today they beat estimates again. They sell a home as a commodity. They don't have a home seller to deal with it. They have their home, and what they do is they'll cut prices if they are too worried about inventory building up. They'll buy down mortgage rates. 33% of new homes sold in the fourth quarter of 2022 had buy downs, which means mortgage rates are under 5%. Now, the latest number is 21%. So the frustration is getting that buyer seller to negotiate something that's workable for two, where the builder doesn't have to deal with that. But whenever rates rise, it always happens. Demand gets hit. I think what happened after 2008 was mortgage rates were falling and people didn't see the demand. Well, guess what? That was a credit boom and a credit bust. Credit was getting tighter in relationship to home sales booming. One stat that not a lot of people know is that in 2020, existing home sales ended only 130,000 more than 2017 levels. That was it. This great housing sales boom that everybody talked about, not that much different than what we saw in the previous decade. If I average out the 2 years, it's only 350,000 more. So I call it the savagely unhealthy housing market. It's just because all of you have to deal with people. And people are not like a commodity home sitting there waiting to be bought. That is part of the educational process of teaching sellers and buyers how this marketplace works and pricing and everything. Whenever mortgage rates go up, demand falls. Whenever mortgage rates fall, demand gets better. No, it's mathematically impossible. I remember going on to CNBC last September and looking at the growth rate of rents. We were running at 25% on a historical basis. It was the fastest level in recent history. And then growth rate starts to cool down just because wages don't keep up. Early 2020, I remember talking to the Washington Post. I said, rents are about to take off. Besides the total inventory being low, guess what? Rental vacancies were at all-time lows into the COVID. The history of global pandemics going 800 years, it's always inflationary for rent, right? There's this big inflationary push in rent inflation. We had this in 1918 to 1920, and then over time, the disinflation happens. When prices go up, wages have to go up with it. So it's not the other way around. Rent growth was so strong, it just cannot simply sustain that level. So we have the up-to-date real rental data, and it's cooled down noticeably. It'll filter into the CPI data over the next 12 months. So the growth rate of inflation is falling because the biggest component of it, shelter, which is 44.4% of CPI, will cool down. That's why you don't see the 1970s. 1970s rent was enormous. It had three major spikes, especially in the late 70s, early 80s. That was the place to be for money because your rents went up so much. People made a lot of money off of those multi-family construction apartments then.
Okay, I think you have a question.
Yeah. What that was unemployment in order to get fit, especially if so what do you think?
My level of unemployment rates, in this environment, because job openings are so high. So job openings is the data that everyone tracks every month. Job openings in the previous expansion was about 6-7 million. It got as high as 12 million. It's been a big talking point of mine for the last 10 years. The baby boomers are leaving, and they need to be replaced. No country has a Dorian Gray labor market, I say. So to have extreme high unemployment would take a historical shock like a global pandemic, right? That'll do it. You got very high unemployment, recovered very fast. So because areas that have an elderly population, it's hard to get replacement workers. Right? So I don't see the unemployment rate exploding even to 6%, but if jobless claims start to rise, mortgage demand gets better, and there's your problem again. Rates fall, demand picks up, inventory levels can't really grow. If it's a job loss recession or anything like that, it's going to take 15 to 24 months before the new supply hits the marketplace. Unlike 2005, 6, 7, and 8, we had 4 years of credit stress, then the job loss recession happened. So that will be a frustrating marketplace. People will expect inventory to really rise. I think the one thing that can be useful on the inventory side is what I call forced equity sellers. You saw how much equity people have. If somebody loses their job and doesn't feel like they can make the payment anymore, they can sell their house. You won't see it anywhere but the new listings data. So the new listings data will be key in the forced equity selling marketplace. That will happen in the next job loss recession. We will track that on the weekly. So far, we didn't see anything like that last year. Of course, this year we're trending at all-time lows.
Hi, I think you have a question.
Traditional buyers with themselves. Third, wasn't the party of the act.
Millennials were the biggest home buyers in America. They started buying in 2013. Every single year they rose. They were the biggest buyers up until 2022. And guess who surpassed them? Baby boomers. You know why? They don't finance their mortgages as much. 50% of their purchases are with cash, where younger Americans have to finance their mortgages. So for the first time in many years, actually technically Gen X as a generation was the highest percentage, but nobody cares about us. Everybody likes that 90s music. They were just too small. The baby boomers are so big, and the millennials are so big that they subgrouped them out. But the baby boomers finally got those pesky kids away, and they had less competition, especially toward the second half of last year. So we have data to show the percentage of buyers. Right now, they're somewhat evened out. The boomers slightly outpace the millennials. So when we think of home buyers, first off, home buyers, move-up buyers, move-down buyers, cash buyers, investors, the biggest percentage are still going to be millennials or Gen X combined. Gen X most likely is moving up. Millennials are first time. Baby boomers would be downsizing. So every county has a median age group, right? Some counties are older, some counties are younger. 50% of our population in America is like 7 areas, just because those are the youngest areas out there. If you wanted to target one, you check the population median age of your local area, and then look at the home buyer profile. If it's the baby boomers, they're still buying. If it's Gen X, they're still buying. If it's younger Americans, especially with rates up, not so much. But millennials were the biggest home buyers in 2021, 2020, starting from 2014, and mortgage rates hit them. In regards to student loan debt, majority of student loan debt default are actually from people that never finished college. It's less than $10,000. That data line has gotten so much press, but the people that actually finish college have the highest net incomes, so they actually are traditionally the bigger buyer. But those that never finish college, actually all the stress, 70% of student loan debt is actually under $15,000. Then you have the doctors, the lawyers, and as a percentage, it's not that big, but they're massive. College educated, we call them DICE, college educated dual income households. They are typically the better profile buyers in America. So oddly enough, the people that have the bigger student loan debt, especially if it's dual household incomes together, are home buyers. I know here in Southern California, where I lived, a lot of my clients, they have like 60 to 120,000 in student loan debt. They're still buying 700, 1.2, 1.5 because their incomes combined together 240, 420,000. So student loan debt is a bit tricky, but the majority of the stress that we see in the data is actually from people that didn't finish college. It's less than $10,000. They actually haven't been making payments for years. So when they start with the new student loan debt payment, they're still not going to be making the payments anyway. That's why they came up with a 10,000 number in terms of getting people wiped out. Is because if you wipe out 10,000 student loan, the majority of student loan debt is actually gone or reduced to a very low percentage because it's a very low number. The people that finish college, they typically make the money and their financial profiles are better. There's always some story about some doctor that has $400,000 of student loan debt and can't make anything. But the data is actually pretty one-sided in terms of if you finish school, especially getting dual household income, you're the buyers out there. So I think for renting, profiles get hit harder with any student loan debt repayment system. But if you ever want to buy $10,000 worth of labor, that actually takes out a lot of the student loan debt off the books on the record.
Interesting. We had Kyle.
So you had that we proposed 28, 35-year-olds, and last year we had that waterfall drop in demand. Curious if you have any data. So it rates 5%. How much demand is there on the sideline?
Existing home sales will get up to 4.7 to 5.3 million. That'll be a big noticeable increase. Actually, not a lot of people know this. When mortgage rates started to fall from November, December, January, one of the existing home sales prints recently was the biggest, or one of the biggest home sales month-to-month prints in the history of America. We went from like 4 million to almost 4.6 million. 600,000 homes on the monthly print, that is not normal. But that's how much demand was there once rates fell just 1% lower. You get down to 5%, you can get up to 4.7 to 5.2. That actually takes us back to pre-COVID level out there. So that's how much rates would impact demand, but rates have to stay low. Like, I don't know if you guys remember, we went to 6.25%, we went to 5% for like 3 weeks, and then we shot up to 7.37. That's not a normal market. That's not how it's supposed to work. I mean, people in 2013 freaked out when rates went from 3.5% to 4.5% in 1 year. That was a lot of drama last year, right? Mortgage rates gone wild, let's say. So it really messed up the market. Really, a lot of people who were potentially listing pulled it out of the market, and we haven't gotten them back. So I think if mortgage rates just slowly come down, give people some time so people feel comfortable. Because one of the things I ran into is people said, I'm not listing my house and having mortgage rates jump on me 2%. Because what if I sell my home? I was looking at 6% rate, now it's 7.5%. So that's the difficulty of having mortgage rates be so wild.
Do you have a prediction in regards to, let's say, from now until 2030, the rest of this decade, what do you think that
history of mortgage rates have gone down. Mortgages, bond yields have gone down for 800 years, right? I have charts going back 800 years. So the 1970s was an abnormal period of time, oil shock, the baby boomers, we didn't have a lot of supply of homes, inflation took off. The trend to me, when everything gets back to normal, like it does with a lot of people say, well, America has a lot of baby boomers who are leaving the marketplace and wages have to explode. 40% of Japan's total population will be dead by the end of the century. So they don't have wage inflation at all. They've been running at low rates. The supply of goods and services, that's the question. If it gets back to normal, rates go back down to the lower range. And that would be normal with every history cycle that we've seen, especially with the entire climate that's aging in society. You really only have inflation if war or some kind of supply shock. World War I, World War II was inflationary, oil shock was inflationary, COVID was inflationary. Just like it was in 1918 to 1920, we had major inflation issues early on, and disinflation after that.
I think we just have one last question. If anybody else has anything else, I want to give everyone time to network.
So my question is, I don't know if you had data about the commercial too, but as you noticed with the last couple of years, the offices down from big companies have a very big space of offices to small because everyone now working remotely. Now, I don't know if this will affect the residential way because these buildings, you know, they have to pay their mortgage, and what's going on now with them, they're going to be in default by the end of the year. And I noticed some of them, especially in New York, some of them, they start moving from commercial to residential, either to sell as a condo or as a rent. Now, do you think that will affect or increase anything in the residential market?
One of the reasons why that's difficult to model out is that the codes for buildings and commercials don't actually fit for residential. And because of that, has anyone seen any commercial real estate buildings actually switch 100% into residential?